Ladies and gentlemen, good day and welcome to the earnings conference call of SH Kelkar and Company Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anup Pujari from CDR India. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us on SH Kelkar and Company Limited's Q3 and 9M FY22 earnings conference call. We have with us Mr. Kedar Vaze, Full-time Director and Group CEO, and Mr. Rohit Saraogi, EVP and Group CFO of the company. We would like to begin the call with opening remarks from the management, following which we'll have the forum open for a question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Mr. Kedar Vaze to make his opening remarks.
Good afternoon, everyone, and thank you for joining us on our Q3 and 9 months FY22 earnings call. We have reported a steady performance in the quarter and 9 months Q3 FY22. It's grew by 6% on back of rebound in consumer demand and new client wins. Emerging markets reported a 3% revenue growth on account of subdued volume, particularly in December due to pandemic disruption. European market reported constant currency growth of 8% with 18% growth in CFF's core business. In our core domestic fragrance business, we saw improved demand momentum with revenues improving by 12% year-on-year and 3% sequentially. The Southeast Asia region continued to be affected by the COVID surge and is yet to recover. Furthermore, there were supply disruption during the quarter that has impacted export shipments. On the raw materials front, we continue to witness cost pressures on account of global inflation, with additional challenge due to supply chain constraints and logistics. This moderated our profitability performance and margins on a year-on-year basis. However, despite the ongoing challenges, on a sequential basis, our margins have remained in the stable range. Gross margins stood at around 41% and EBITDA margins stood at 15.8% in Q3. In order to mitigate cost pressures, we are working with our customers and undertaking price hikes. Our profit after tax in Q3 has come in at rupees 32.4 crores. Coming now to some key business updates, we are happy to share that we have acquired 62% stake of Holland Aromatics, a leading fragrance company in the Netherlands. The balance 38% will be acquired in 2 tranches, 19% each, over the next 2 years. The transaction brings on board a high potential company, strong local presence in Europe, particularly Northern Europe, complementary to our CFF business. A proven expertise in the F&F industry, along with the blend of capabilities from CFF, Nova, and Holland Aromatics, will strengthen our endeavor to tap upon diverse customer segments ranging from local MNCs and particularly assist us in our endeavors to take global MNC business. Here we are also pleased to share that we are now participating in a global RFP, that is request for proposal, and engaging with a large global FMCG MNC for commercial tender submission. This is a global business in excess of $1 billion, which is up for negotiation. This is a key step in the world, sets the stage for SHK to tap upon further global opportunities and a key focus area that should drive the next leg of growth for us. In another key development during the quarter, the board has approved the acquisition of 100% stake of New Taste Food and Drink Labs. This acquisition accelerates the momentum of our flavor business and enables us to further expand into the high potential flavor categories such as syrups, sauces, seasoning, fruit preparations, and other such premium grade products. The transaction brings on board a solid and reputed customer base across the fast-moving FMCG and particularly QSR space. Overall, both these acquisitions are value accretive, synergistic and growth oriented. From a consolidated balance sheet perspective, our net debt position stood at rupees 438 crores as on December 31st, 2021 compared to 347 crores as on September 30th, 2021. The increase in debt was primarily due to higher working capital in the current inflationary environment. I would also like to share that following the conclusion of our latest two acquisitions, we expect that our net debt will reach levels of around 550 crores in the coming quarter. While we had indicated in the past that we would be reducing our debt levels, these acquisitions presented significant potential for future growth. Both acquisitions are highly growth oriented and as such rare in our globally competitive and highly consolidated industry. They align and fit perfectly with our vision of emerging as a notable player, particularly with global MNCs. Having said that, we have historically been conservative on debt and we would continue our endeavor to reduce debt from the next quarter onwards. To conclude, the Omicron variant impacting discretionary spending to some extent, we witnessed moderate growth in December and January. However, we are operationally in a strong position, seeing healthy wins across the markets, and our strategic initiatives and participation in global RFP should result in positive growth momentum over the next few fiscals. Overall, we are confident on driving growth should enable us to report healthy performance going forward. I would request the moderator to open the forum for any questions or suggestions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Viraj from Securities Investment Management. Please go ahead.
Yeah, hi. Thanks for the opportunity. First is on the acquisition. So, if you can just provide some more detailed perspective, what kind of complementary portfolio and, addressable market opportunity kind of open up so far. And, you kind of also alluded that it provides a high growth opportunity. So if you can elaborate a little more.
So let me start with Holland Aromatics. Holland Aromatics is a niche fragrance manufacturer in Netherlands with about roughly 6.5 million top line annual revenue and greater than 2 million euros EBITDA. It is in close proximity in the manufacturing site to our sites, both the erstwhile manufacturing site and the development laboratories in Amsterdam. Given its proximity and ability to work together with our development site, we are very confident of further expanding their business into Northern Europe, covering Benelux and Germany as an additional market. We already have our CFF manufacturing site in Italy, which allows us to cover most of Southern Europe and eastern parts like Turkey from supply from Italy. So this two manufacturing site approach will help us to consolidate our position in Europe. Additionally, there are a couple of global MNC FMCG companies with strong presence in the Netherlands from their development and headquarters or corporate global working. So the Netherlands acquisition also strengthens our liaising with the global headquarters or R&D centers in the Netherlands with these companies. So this allows us to grow the CFF and European business on a much faster keel as both North Europe, South Europe demand can be fulfilled in one composite group. Additionally, Holland Aromatics has businesses in export businesses in Indonesia, and as you know that we have embarked on a 3I strategy with Indonesia, India and Italy being our focus areas for future growth. So Holland Aromatic complements the business that we are doing in Indonesia, and with their support, and they have some tie-ups in the Indonesia market which we will benefit going forward. As to the second acquisition, which is New Taste. New Taste is in the space which is traditionally between flavor and FMCG product companies. So for example, we are making chocolate flavors, they are making chocolate sauces and chocolate inclusions for biscuit or bakery confectionery companies, and with this the complementary set of products that go to FMCG and pharmaceutical companies, we are able to offer the full complement of products. They are already working with large FMCGs like Unilever, Britannia and so on and so forth, and so with the offering of both flavor, direct flavors and flavor plus addition products, we are able to cater to entire requirements of the FMCG, bakery, confectionery, pharma sectors. Apart from that, they also have a solid meaning powder flavor facility, together with our earlier acquisition, which has given us some amount of savory flavors. We are now targeting the QSR business and savory flavor business in combination, where in all the food segments there is this dual kind of approach. One is the concentrate flavors and the other is ready to use flavors, and in this the New Taste FDL is complementing our concentrate flavor business by having ready to use products for QSR and FMCG companies, including nutritional supplements, nutrition business and flavor for beverage, pharmaceutical and bakery industries. Complement the flavor business, and it allows this to grow beyond the traditional R&D led flavor usage to broader usage, including large canteens and some of the mid-sized food delivery and food companies which utilize flavors in a ready-to-use form. So this is giving us another growth opportunity for our flavors business.
Just one follow-up on Holland Aromatics. So we paid around 13 million euros and for 62%. So on a total EV to sales, we will pay slightly upwards of 3 times sales. So internally, when we're saying that we expect a high growth, what kind of a growth we are looking, and is it led by firm customer wins?
10 times of EBITDA if you look at in terms of EBITDA.
Okay.
That's with high margins. It's a 10 times of EBITDA, and we are very confident to replicate CFF type double-digit growth within Europe. The company has been growing at excess of 10% CAGR in the last 3-4 years, and we will supplement and complement that with our CFF and KEVA technologies to further continue this momentum.
Okay. Second question is, with the Holland Aromatics acquisition and the other one as well, you said our overall net debt would be close to 550 crores. So over next 1 to 2 years, do we have any aspiration, target in terms of what kind of a debt levels we want to settle down at? Any perspective you can share there? And we also in the December business update we talked about paying a 12.5 crores for participating in global RFQ. So that's including in the current quarter numbers, or that is which will yet be reflected in Q4?
So the 12.5 fee is WIP. It is not yet payable. It is not crystallized. So we are currently in the business discussions, and once the RFP is submitted, we hope to get sufficient business to be able to cover our investments in this tender process plus 3 years business growth. So the total tender quantum is excess of $1 billion, and we are waiting and expecting the first awards of business to come in the next probably next 2 months, and then it's a process whereby the entire business will be awarded over a period of 12 months thereafter.
And the cost will get amortized over a period of the contract. So suppose if we get a contract for a period of 2 years or 3 years, the cost of 12 crores will get amortized.
Okay, and on the debt part?
Debt. Yeah, so debt reduction, we are already looking at that as we talked earlier. The high inflation in the raw material has meant that almost 50-60 crores of additional raw material value we have taken for the same volume that we have been managing and keeping. We believe that once the raw material inflation stabilizes in 1 quarter to 2 quarters, this kind of money cash flow will quickly come back. In addition to the operating profit of that quarter. So there is a ballpark 60 crores of working capital which has gone in, and as the sales price increases take place, the this entire working capital has to go through the cycle for us recoveries, and we will get these 60 crores out of the working capital in addition to the operating profit of each quarter.
Okay, I'll come back in here. Thank you.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Madhav Marda from Fidelity International. Please go ahead.
My questions have been answered. Thank you.
Thank you. The next question is from the line of Lakshmi Narayanan from ICICI Prudential AMC. Please go ahead.
Hi, good afternoon, Kedar. Just 2 questions. If we look at the history, the last 4 or 5 years, you have done several acquisitions, right? Maybe small tuck-in acquisition to large ones, right? So, if you just put it together over the last 4 or 5 years, what has been the experience in terms of the total capital that has gone in for acquisition, how that has actually benefited the company, either qualitatively or quantitatively? And subsequently, how do you look at it, whether these are, this will yield results, one shouldn't look at immediately, should we look at long term? How do you look at it? Because there is CFF, last year we acquired something, and this year also we had this, right? While I understand these are all synergistic, just to understand how much capital has gone in, what has been the results qualitatively and quantitatively.
I think, Narayan, if you allow me to send that statement with the total capital outlay and a specific comment on each acquisition and where we are, that's probably a better way of looking at it. So we will make an update on this and send it.
Yeah, maybe one suggestion is that maybe in your presentation itself, you can actually just put a chronological snapshot of acquisitions, what has been done, so that it will be helpful for investors at large.
That in our annual report where we can do justice on the total discussion. So we will make a section in annual report with our last 5 years view on acquisition and way forward.
Got it. But anything on the top of the mind you want to tell, not numerically, but any qualitative?
So going back to the strategy of the acquisitions, we have done acquisitions, first leg of acquisitions on the ingredients, the second leg of acquisitions on the flavors, and now recently to expand further the fragrances business. In each wave we had a specific strategic target as to why we want to do the acquisition and what are the benefits for that acquisition. I think by and large, I would say 9 out of 90% of the objectives have been met. In terms of the particularly the environment on GST and post the pandemic, the subsequent penciled growth rates of the economy or customer side have not panned out, and that's why some of the acquisition value and the debt has gone up faster than we had originally planned. But these are matters, I would say, within tactical 1 or 2 years of slow growth and pandemic situation. Otherwise, by and large, if you see the CFF, which was not facing the same kind of pandemic pressures, we have delivered the double-digit growth. On the various flavor acquisitions we have now integrated last year, and you've seen that last year or 2 years we have a double-digit CAGR growth in the flavors. There is good traction in terms of product development and approach. So overall, I think the acquisition strategies have been well worked out and it's working well. We now need to focus on consolidating the acquisitions to build the synergies that we will take up in the next 1 or 2 years, that we consolidate what we have. The key point here is that now we've also been able to demonstrate manufacturing and capability outside India, and one of the key conditions of the global MNC RFP, as I've mentioned earlier, is innovation and geographic spread beyond one location or one country. So with the Italy and now Holland manufacturing, India manufacturing and China manufacturing, we are now in a position to participate on the global RFP. So on the strategic front, the views that we had on the acquisitions have largely been fulfilled. On the tactical front, yes, the revenue growth has not happened in the same manner that we had penciled when we did the acquisitions. But I attribute large part of that to the pandemic situation, because as soon as we've seen non-pandemic quarters, we are doing good growth.
Got it. So, if you just look at next 3 to 5 years, right? Would you be looking for more acquisitions, or you would first looking to consolidating this? How do you think 3 to 5 years out?
So I think our appetite for acquisition is sort of, there is a passive and active appetite. So right now we are in a situation of consolidating what we have just recently acquired. Till we are able to consolidate, bring down our debt to levels of less than 2 times of the EBITDA, we would not look at any further acquisitions.
Got it. And in terms of your cost of debt, right, what is your approximate cost of debt? Because on the balance sheet appears to be less than 3.5% or so. I don't know whether my calculation is right, but just
that's right. The cost of debt is somewhere between 3 and 3.5%, because most of the debt is in overseas US dollar or euro denominated debt, and underlying businesses are also generating sales and return on the same currency.
Right. And we have been in the last 1-2 years, we have been accelerating on acquisitions. Is it that there is some kind of a change in the landscape, that a lot of assets are coming at good prices, or one is of business need, but why a lot of assets are coming up, and how do you think about it? Whether some consolidation is taking place or not?
I think the obvious answer that there's a lot of liquidity in the market, and there is a strong consolidation, wave of consolidation, not only from our side but as an industry. All the large players and significant players are on substantial acquisition in the last couple of years. Plus, these mid-sized and smaller businesses have had to deal with the pandemic and effects of the pandemic, which is making it attractive for them to sell their business, or in cases joint venture or otherwise. So there is a situation between sort of two opposing forces: liquidity driven acquisition plus sort of businesses are willing to make a deal at this time because of the uncertainties. That is why there has been a spate of acquisitions in our industry, and I think in a lot of industries recently. The other flip side, and the reason we needed to participate in this also, is to ensure that we have some of our strategic goals in terms of Europe and further growth on flavors, that we don't fall behind, and there is further consolidation of the industry, that we don't get get a chance to participate in the future. So some of the acquisitions we have needed to do, making sure that we have a foot in the door, and we know that there will be a player in the market in different geographies or in different business segments where we need to have our next leg of growth.
Sorry, just one last question from my side. So if you split the business into India and non-India, and again fragrance and flavors, which you think will grow faster and also be more margin accretive? Is it the India fragrance will outpace, or the India flavors will do, or the international piece?
So I think the opportunities are the following. We have the global RFP, which is largely on the fragrance, which will not be only India-centric. It will be on a global nature. Our acquisitions in Europe are on the mid-size and smaller end of the fragrance customers. So they are the areas which are growing faster in the developed market. And we continue to engage with all our large corporate customers within India and South Asia, which is a third leg of growth. Having said that, on fragrance, I think the Southeast Asia region particularly has been affected in the pandemic on a sort of longer timelines than Europe or Middle East. And we are looking at the correct strategy and timing to restore the growth momentum in Southeast Asia. So out of the three regions, Southeast Asia has been lagging. India is following market. Italy has been ahead of market on both current and in terms of the future potential. In the flavor side, you are seeing the numbers. There is a strong growth, and we believe India and Southeast Asia, or India as a flavor and food market, is a very large opportunity for us in the next almost decade or 2 decades, as the trend towards flavored products starts to increase.
Okay, and any I mean, what has been the 2-year CAGR of the fragrance division, domestic and international? I mean, I have the 1-year number which is there, but what has been the 2-year growth?
Fragrance? Include everything. So, India. So the fragrance 2-year CAGR has been 4% on emerging markets and 11% on the developed markets in Italy, and flavor CAGR is double digit in across.
Sorry, you said India is 4%. Is that what I heard? 9 months?
That's right. Yeah.
Okay. Thank you so much, Kedar.
Thank you. The next question is from the line of Sachin Kasera from Swan Investments. Please go ahead.
Yeah. Hello, Mr. Raju.
Sorry to interrupt you, Mr. Kasera. May I request you to speak on the handset mode?
Yeah. Hello, sir.
Yeah. Hello.
Yeah. Sir, my question is regarding the tender which you highlighted are opening up in next couple of months. Could you talk in a bit detail about them? Who will be the peers? Which segment you will be looking at? The size of the tender, the business you are looking at.
So at this moment, I am only at liberty to say that it's a well over $1 billion total global annual potential, which we are bidding for. There are various bidders, and over the next 12 months, the tender, which is sort of a total global tender, will be broken up into specific bidding portions, and that process will complete in the next 12 months. We should have our first results in terms of business award or potential business award sometime in the next 2 months, and then following that we expect a 12-month process where various subparts of the overall business are then kind of tendered and negotiated, and going forward the business is start.
Okay, so what is the duration of the tender?
Multi-year agreement, excess of 3-4 years agreement to supply, and it will start, I think, somewhere in April in terms of the timelines of the process, and it will continue thereafter business by business throughout the 12 months the next year.
Sorry, sir, I missed that. So from the time we get we win the tender, how long does it take for the to show it in the P&L?
So, assuming that you have a business opportunity tender in April, it probably months before the change in the business happens.
Okay.
If the tender is awarded in April, the business should start in 1st of October, something like that. 2-quarter delay between the award of the business and the actual revenue flow.
Okay. So, versus a $1 billion tender size, what sort of, are we looking at in terms of the, the business opportunity? The customer will also look at our P&L size and, kind of give the business accordingly. How should we kind of understand this?
So I think obviously we are bidding for all parts of the business, but in terms of our strategy and our current operations in India and Indonesia, we stand a better chance in these geographies and certain specific categories. It's a very complex process, and I'm not at liberty to divulge any more details at this moment since it's a process work in progress. But we expect sizable growth opportunity in this tender over the next 12 months, starting from April, May, when the first results start coming in. And we anticipate that in terms of size of the business, the total size is over $1 billion. But very, very practically, even if we look at 5% of that business being materialized in reasonable short term, that's something which is exciting for us to take forward.
And sir, $1 billion, just clarifying, will be the annual size of the revenue or it's over time of the contract?
No, annual revenue size is more than $1 billion, and we hope to start somewhere with 5 to 7% of that business in the first wave.
Okay. And sir, can you please repeat the fragrance industry CAGR, 2-year CAGR, which you just mentioned with the other participant, for the Indonesia, India, and Europe market?
Yeah, so India, as I mentioned, is 4%, the South Asia, MENA, Europe is 11%, and Southeast Asia is -2 CAGR growth, somewhere -2, -3, where we have had supply disruptions and slow growth.
Okay, so this is F&F combined?
This is fragrance. Flavor is largely 11% CAGR growth in 2 years. We don't divide it into domestic or it's largely India, South Asia region.
11%. Okay, India and Southeast Asia. Okay.
No, it's India, South Asia, what we call SAMIA, so Middle East and South Asia. This region we monitor our markets in emerging and markets, and so further in South Asia, Middle East as one, and Southeast Asia as a second.
Okay. And sir, coming to this Holland Aromatics acquisition, so you mentioned we paid 10 times EBITDA?
10 times EBITDA ballpark number, yeah.
Okay. So that is almost similar to our valuation.
That's correct.
Okay. So was there, I mean, how many other companies were there along with us? If you could...
In terms of?
In terms of bidding for the asset, was there any other companies? Or?
I don't have full information on that, so I don't want to speculate.
Okay, fine, sir. We'll come back in the queue. Thanks.
Thank you. The next question is from the line of Bharat Sheth from Quest Investment Advisors. Please go ahead.
Hi, Kedar. Good afternoon, and thanks for the opportunity. Kedar, just, all the questions have been answered. One question, recently that Swiss company which acquired 10% stakes in our company, which is, of course, we are already working with them. So with that, their acquisition, do you think it can open up more door for us, our company, to do business with them?
So we are already, within the fragrance and flavor industry, customers and competitors and suppliers, it's a common pool. We buy from all our competitors. Competitors buy from us various ingredients, and we compete on the final formulation and composite business of the FMCG. So there is always a buy and sell relationship within the industry with many people. With this 10%, really it's just I would say industry insiders thumbs up on our strategy and growth potential. And we are already discussing and working with Firmenich on various initiatives as a normal business development, and I think this may open up some further initiatives on that front. I just want to stress that we are an independent company in the industry. We have no tie-up with Firmenich or anybody else, and we continue to remain independent and operate our own strategy in the future.
Okay. And this Indian acquisition, how that big, what of that company, and that how much really with the complementary products, and so cross-selling opportunity is there for us?
So they are about this year revenue should be 30 crores ballpark. Is estimated between 30 and 40 crores they will end up, depending on the pandemic scenario. If it's eased up, maybe the revenues will pick up. But we expect somewhere between 30 and 35 crore of revenue annualized basis, and that adds nicely to our own meaning 120 crore annualized basis revenue.
And their EBIT, any color on their EBITDA margin?
So I think their EBITDA margins are lower. As I mentioned, we are in the concentrated flavor business. They are more in the ready-to-use business. Their EBITDA margins are in the 7 to 8% range, but that is on a much larger volume, more linked to commodities and QSR and direct-to-consumer usage, and also with the FMCG customers. So they are sort of in between step, and the concentrated flavor is converted into either a chocolate sauce or a chocolate inclusion or a spicy sauce, and those are then included by the FMCG or kitchens or direct-to-consumer product companies. So it's a step down from our concentrated flavors into a ready-to-use flavor market. So it's much higher volume from a volume point of view, but most of it is commodity trading, and value addition comes from the flavor and nutraceutical elements.
Okay. So any cross-selling opportunity, some of our customers may not be common, and that can open?
There are good complementary set of FMCG and clients, and certain segments which are not our current clients, like QSR and common kitchens, canteens, things like this, which are not using direct flavors but using ready-to-use flavor mixes. So their business is a straight add-on business in terms of our approach to the client. The large clients, if they have a full-fledged R&D, are often buying concentrated flavors, but the mid-sized and the sort of kitchen, canteens, QSR, fast food chains, they are interested to buy ready-to-use flavor products. You've seen, for example, Peri Peri and all the fast food chains have their mixes on top of their product, and all these are QSR products which this company also makes. So it's a very good direct approach to customer segment which we don't have, and a complementary product mix to the customers that are common.
Okay. Okay. And thanks. So, Kedar, if we can give some color on now with pandemic maybe at the back end and how the Southeast Asia market will open up. So next year, what kind of, your with the whole consolidated number you look and kind of EBITDA margin that we are envisaging. One more product that we had tied with which was done R&D and ultimately BASF took, and now we have got our marketing right for that product in India. So is that ramping up, that product?
Yes, that is ramping up. Again, this is being an expensive product. It is not easy to ramp up during the pandemic situation because it requires presentation to the clients and users and how to use and so on and so forth. So we've had a stop and start, and between the two waves of the pandemic, we were able to convert few clients. That business has started ramping up quite well. I think next year we expect it to touch 30 to 40 crores in annual revenue if everything goes normally.
And the Southeast Asia market, what's your sales on next year?
So Southeast Asia market, I think our basic product range and product type, everything is well accepted. It's a question of the supply chain particularly being disrupted during the pandemic. We are looking, as I mentioned, the Holland Aromatics also has certain business in Indonesia particularly, and we are looking at local manufacturing or local supply chain enhancement, which will allow us to regain some of our lost market share. In a normal environment without any pandemic situation, I think we will restore our 10-12% growth rate in Southeast Asia as well.
Okay, thank you and all the best, Kedar.
Thank you.
Thank you. The next question is from the line of Suraj Fatehchandani from Compound Everyday Capital. Please go ahead.
Hi, thank you so much. Questions have been answered.
Thank you. The next question is from the line of Madhav Marda from Fidelity International. Please go ahead.
Yeah, my question was that, earlier when we, for these RFPs, the global RFPs, it was a bit tricky for us to bid. But now that, the opportunities have started opening up, what has really changed that, now we can bid for these large global tenders? Just wanted to understand on that.
So, nothing has changed. We were always knocking on the doors. I think if you see the commentary we've been talking about in the last 3 to 4 years, that this is an opportunity of growth for us. I think finally we have been able to initiate that and take it to the next level.
Okay, got it. And this new business, like you said, we are targeting something like 5 to 7% of that global tender. Like typically margins on these contracts, are they similar to our existing business margins, or are they like higher or lower, given that it's a very large size contract?
So typically the gross margin level will be lower, but the net margin level should be similar because the typical volume and the kind of overhead per kilo costs and other benefits in terms of operating leverage. So we are looking at it in totality where we don't see an erosion of net margins. We would see definitely a smaller gross margin on a much larger base. So that will be a typical scenario. If you look at our current composite margin of 41%, it varies from 30% to 50, upwards of 50% between the small and the large products. And with the size of the global business, we probably look at somewhere around the 25% gross margin level. It will have to be product by product, country and specific discussion, but yes, it will be on the lower end of our gross margin level, but there will be much larger volumes of business with the shorter lead times and shorter inventory cycles. So we anticipate that is a different kind of business.
So it's 25% gross margins and EBITDA margins are like 15-16%, or they're a bit lower?
Yes, I think the operating cost, and it really depends. We have no color on exactly how much business, which business we will get. But assuming we get an average, cross section of small and big businesses, we will be in a ballpark 25% gross margin and 15% plus EBITDA margin. Then it depends on the synergies with the rest of the business. If it is similar in the common raw materials, things like this, then we will have a further benefit in the EBITDA margins.
Good. And last question is, everyone has been facing the issue around raw material inflation. Do you think Q4 we'll be able to pass through most of it, or it's going to the impact will last more into Q1 of next fiscal?
So I think there is not that raw material inflation is static. It's a dynamic thing. There is continuous pressure even in this quarter and as we speak. So we've been able to pass on some of it to the client. Some of that we are managing through the inventory management and inventory stocking that we have done. I don't have a specific timeline in terms of when the inflation will stop or how things will pan out in the future. As of now, we see the first quarter, January, March, we should be in similar gross margin as the quarter 3. That's our target, and we will continue to push selling prices in line with the cost price increases and manage to hold our gross margin at these levels. However, if there is another bout of high inflation, it may not be possible to maintain the gross margins. We will come back in our business updates.
Understood. Thank you, sir.
Thank you. The next question is from the line of Vipul Shah from Ripple Wave Equity. Please go ahead.
Hi, Kedar. Just wanted to understand from your perspective. First of all, congratulations on this really brave step of, considering bidding for this huge opportunity which Kelkar is looking at, SH Kelkar is looking at. So apart from the fee which you have mentioned in your business update earlier, assuming that assuming that our company is in a position to bag the contract, will there be a specific additional plant requirement to be put up? So how are you looking at the capex for this?
So again, as I mentioned, it depends on the nature of business and the final award. The objective and the manner in which we are negotiating that if there is any additional capex, then it would be something that will get amortized over the period of the contract, and we will recover from the contract period. We expect not very large amounts of capex because most of the plant and machinery and the requirements for this are already in place. But in the event they need us to put any dedicated facility in any part of the world or somewhere, any sort of additional capacity for whatever reason, then we will have that paid back through the contract period amortization.
So what I understand is that if the contract size is say X amount, it can be catered to from our existing plants. But if it's say beyond X, then we may have to do some capex. And as you said, we will be able to recoup in terms of our IRRs, right?
Yeah. Largely in the geographies where we already have a plant or operations, there will not be a capacity constraint. But tomorrow, since this is a global tender and they, let's say, want me to supply 1,000 tons of fragrance in Argentina, then we will have to set up something to manage that supply chain, and we will amortize those costs accordingly through the period of the contract. I believe India, Indonesia and Europe, we have assets on the ground sufficient for no real or large investments. For the other regions, particularly the Americas and Africa, we may require some investment if such a business does arise. But it will be discussed with them at that time from a capex neutral point of view. All our proposals are based on zero capex basis. So if there is a capex requirement, we will have that as an additional cost to the manufacturing.
Thanks for this, and all the best.
Thank you.
Thank you. The next question is from the line of Nikhil Upadhyay from SIMPL. Please go ahead.
Yeah, hi, good afternoon. Am I audible?
Yes, sir, you are audible.
Yeah, hi, Kedar. Congrats for this deal where we are bidding. The point which I think this question was raised earlier by a participant, but I just want to have a follow through. Like we've been saying for 3-5 years that we were trying to get in and break into the MNC customers, and we were putting all the efforts. But just to understand, is it like now probably our scale has reached to a level, or our balance sheet strength has reached to a level that we are being invited for such kind of deals, or what exactly has changed that we are able to go and participate in these deals now? That is first. Second part is, do you see that probably, I know whatever the outcome comes, do you see that more such inquiry levels could be coming up in terms of for the future for Kelkar as a company?
Yes, so to answer your question in two bits. First is that it's a step-by-step development. 3 years ago, we got a small engagement which we started the business last year, which was a kind of annual potential of 1 crore, so it was sort of test. This year, last year, September, we also, so this kind of, we won the business. So 2021 September, we won a local business which is ballpark 20 to 30 crore annualized revenue. So I think the steps of Unilever qualification kind of have been taken through, and this is sort of indicated, and they have been able to, or this information has been important that the global companies are looking at it.
Okay. Second part was like when you said consolidation of our acquisitions. One is like streamlining the processes and bringing the cultural and R&D team on single page. But in terms of growth aspects, when you probably did these acquisitions, and how do you see that growth aspect in terms of consolidation? So when probably say you said one of the companies is a 30 crore kind of a top line, another is a 13 million euro kind of a top line. What kind of growth do you believe that probably once our consolidation phase gets over, this is the kind of scale these companies should achieve, or probably this kind of revenue these companies should be able to provide to Kelkar? How do you see that growth in terms of the consolidation phase? And secondly, on the margin profile, do you think there is enough opportunity to improve the margins in these companies as well?
So as a general case, the margins in the European markets are better than in the Asian markets in almost all product categories. So we are adding that additional margin leg to our overall product portfolio. We are also dividing our R&D expenditure over larger base of customers and products, which helps us in terms of a per kilo or per revenue cost of R&D to amortize it over a broader base. So this benefits both the companies which we have acquired as well as our current R&D team to monetize their research at a faster timeline. Having said that, the opportunities are different. The global opportunity we have already talked. Plus, we are looking at European market opportunity through these two acquisitions of CFF and Holland Aromatics. We believe that the European market, like most developed markets, has undergone a major transition point in the pandemic, and we would see a spate of new type of products, particularly going direct to customer through the digital platforms, which is the growth leg which CFF is already benefiting from, and we see similar growth in Holland Aromatics, and combining these, we can bring further operating efficiencies and then further grow this mid-size and smaller customer and new brand business in Europe. The other acquisition is in the food space. I think we are at the tip of the iceberg as far as QSR and food space in India is concerned. If I have to pinpoint in terms of revenue growth opportunity, that is the single largest exciting opportunity in terms of potential runway, because we are at this moment 30 crores and the business industry is already 2,000 plus crores and growing at a very fast pace.
Okay. Last question, Kedar, if we go back to our previous year's calls, and one of the things was that the company had invested a significant amount in R&D and had created a big pipeline of products, and that is why you had mentioned that probably the R&D cost will remain flat. Or with these acquisitions like CFF and the two acquisitions which we have done, how large does the R&D molecule pipeline or the developed product pipeline become for us? Is it significant enough?
They are not innovator companies as far as R&D is concerned. They are more users. So we have added more markets for our R&D molecules in the European market.
Okay. Fine. Thanks a lot.
There is no additional R&D cost for us. It's actually faster monetization of all the products that we have been able to build and continue to build.
Okay. Thanks a lot.
Thank you. The next question is from the line of Viraj Kacharia from Securities Investment Management. Please go ahead.
Yeah, hi. Just two questions. On the the large global tender, so the customer, whom are they sourcing from currently? I mean, is it one single supplier, or any perspective you can share that? And broadly in terms of approach, post Holland Aromatic acquisition. So if I just want to understand, earlier we're trying to make a similar approach to PFW, a couple of years back, and then kind of fructify what we are thinking. Just trying to understand how different or how differently are we approaching with this acquisition and then the scale up.
Right. So the first question on the global tender, currently the global company is buying from multiple vendors. I don't have the full details, but I guess that it's 4 to 5 vendors on a global basis, and they will add a few vendors in the discussion. The main thing is that the vendors need to be approved in terms of quality systems and process, and we are now sort of a qualified vendor to be allowed to be bidding. So that's the first key milestone to get into the FMCG global system. The second question was in terms of acquisition in Netherlands. So we had done the PFW acquisition, which was largely in aroma chemical, and that has helped us to start to build our R&D capability, plus the relocation of that plant into Mahad. Holland Aromatics is now on the formulation fragrance side. So we will be catering to the demands in Europe, with a local manufacturing. So the intention is to continue to grow that on a 7 million base, together with the CFF, and our objective is to reach a sort of a top line of 100 million euros in Europe over the years.
Okay. Second question is, when you look at ASEAN market for us, so other than Indonesia, which will be the larger markets, and compared to the peak sales we'll be doing that, what will be the current run rate we'll be doing? Just to get a perspective in terms of around.
So I don't exactly understand your question. I think the Southeast Asia market is all the countries in ASEAN. They have collectively almost a 400 million population ballpark, and we expect it to be roughly the size of India in terms of opportunity. So the size of the businesses are large. We are relatively small player, but there is a huge upside on the total quantum of business that is happening in the Southeast Asia market or Asian market today.
So for us, what will be the annual business we will be doing in from ASEAN?
At the moment, it's a ballpark $10 million.
That's including, I mean, obviously including Indonesia and.
That's right.
Okay. Okay, fine. Thank you.
Thank you. The next question is from the line of Bharat Sheth from Quest Investment Advisors. Please go ahead.
Hi, Kedar, just take one more perspective of this global tender. When we are bidding, so we may be aware that which region we need to put a capex and how much capex, if at all, is required. So what kind of a ROC target that are we looking while if we go in this business?
I think the ROC target would be higher than 20%. I think the 20% cutoff we will maintain.
Okay, thank you. That's all from me.
Thank you. The next question is from the line of Mr. Bhavya Sonavala, an individual investor. Please go ahead.
Yeah, hi, sir. Thank you for the opportunity. So my question was, are we seeing any inquiries or are we working with any new age brands, who offer direct-to-consumer products, the new fast-growing brands? Are we seeing any inquiries or working with any of them?
Yeah, we are working with many of them on different products, so it's a normal part of our business growth and engagement. I think in the recent past, this business side has got higher momentum, and there is a good amount of business momentum that the D2C has seen as a result of the recent IPO and heightened awareness in the investments that are going in the D2C brands.
Okay, thank you so much, sir. Sir, and the last question is, when we said in the recent 2-3 calls that we had a couple of new wins. So is this are these new wins coming from a particular part of the business, or is it scattered across all the small? Are there small players? Are there MNCs? Are there what kind of?
Large number of new wins. What we have announced is only a win with a global MNC last year, and that's the one which is led to the RFP which we are now participating.
Okay, thank you so much, sir, and all the best. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I hand the conference over to the management for closing comments.
Thank you. I hope we have been able to answer your questions satisfactorily. Should you need any more clarifications, know more about the company, please feel free to contact our team or CDR. Thank you once again for taking the time to join us on this call.
Thank you. On behalf of SH Kelkar and Company Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.